For years, index funds were considered one of the safest and smartest ways to build long-term wealth, simple, passive, and trusted by millions of investors. But in 2026, more people are starting to question whether the strategy still works the same way it used to. Rising market concentration, changing economic conditions, inflation concerns, and shifts in global investing trends are making some investors rethink the set it and forget it approach. While many still believe index funds are valuable, others argue the landscape has changed enough that blindly following old advice may no longer be the best move. Today we will talk about why smart people are quitting index funds in 2026. So before we get started, make sure to hit that like button. Also subscribe to my channel 10. Most people think index funds are the perfect investment. For years, index funds have been presented as one of the safest and smartest ways to build wealth. Simple, low cost, diversified, and easy to maintain. Millions of investors were told the same advice: buy index funds consistently, hold them long term, and let compounding do the work. And for many people, this strategy absolutely worked well. But in 2026, a growing number of financially sophisticated investors are starting to question whether blindly relying on index funds alone is still enough. Not because index funds suddenly became bad, but because the economic environment itself is changing. 9. Index funds became popular because simplicity worked. The reason index funds exploded in popularity is simple. Most active investors failed to consistently beat the market. Instead of constantly trying to predict winners and losers, index funds allowed ordinary people to own large portions of the market automatically. This reduced fees, emotional decision-making, and unnecessary trading. Over long periods, the simplicity worked extremely well. Many investors outperformed complicated strategies simply by staying consistent and avoiding panic. But when too many people follow the same system without questioning changing conditions, new risks can quietly appear. 8. Market concentration is becoming a bigger concern. One reason some investors are becoming cautious is market concentration. In many major indexes, a small number of giant technology companies now represent an enormous percentage of total market value. This means many diversified index funds are becoming increasingly dependent on the performance of a few powerful corporations. If those companies struggle, entire indexes can become more vulnerable than people expect. Some investors worry that what appears diversified on the surface may actually be heavily concentrated underneath. 7. Passive investing is now dominating the market. Another major shift is the rise of passive investing itself. Trillions of dollars now flow automatically into index funds every year regardless of valuation or market conditions. This creates an unusual situation where money continuously enters the same large companies simply because they are part of the index. Critics argue this can distort pricing and reduce healthy market efficiency. In other words, companies may receive massive investment flows not because they are necessarily the best opportunities, but because they are already large enough to dominate indexes. 6. Some investors believe returns may be slower going forward. One reason financially sophisticated investors are adjusting strategies in 2026 is because future returns may not look like past returns. For over a decade, markets benefited from low interest rates, strong technology growth, and massive liquidity. But economic conditions change. Higher interest rates, global uncertainty, debt levels, and slower economic growth could reduce future market performance compared to previous decades. Some investors believe relying entirely on broad index growth may no longer produce the same exceptional results people became used to. 5. Wealthy investors often want more control over risk. Another reason some investors move beyond simple index funds is risk management. Index funds are designed to follow markets, not protect against every downturn. Wealthy investors often diversify beyond public equities into real estate, private businesses, commodities, cash flow assets, or alternative investments. The goal is not necessarily to abandon index funds completely, but to avoid depending entirely on one system. Financially sophisticated people usually focus heavily on managing downside risk, not only chasing growth. 4. Index funds encourage passive thinking. One hidden danger of index investing is psychological. Many people begin treating investing as completely automatic, without learning how markets, businesses, or financial systems actually work. They stop thinking critically because they believe the market will always rise eventually. While long-term optimism has historically worked, blind confidence can become dangerous during periods of economic instability. Some smart investors in 2026 are not quitting index funds because they hate them. They are simply becoming more active in understanding where their money is going and why. 3. Alternative assets are becoming more attractive. In 2026, more investors are exploring assets outside traditional index funds. Real estate, digital businesses, AI-related ventures, private equity, commodities, dividend-producing assets, and cash flow businesses are gaining attention. Why? Because many investors want assets that generate direct income or provide diversification beyond stock markets alone. Wealthy individuals often focus on ownership and cash flow, instead of relying entirely on market appreciation. This shift reflects a broader move toward flexibility and diversification. 2. Smart investors are adapting, not panicking. It is important to understand that most intelligent investors are not running away from index funds in panic. Many still hold them as part of larger portfolios. The real shift is adaptation. Instead of blindly assuming one strategy will work forever, they are adjusting to new economic conditions. Financially successful people understand that no strategy dominates permanently. Markets evolve, systems change, and investor behavior shifts over time. Flexibility often matters more than loyalty to any single investment philosophy. 1. The real lesson: no investment strategy should be followed blindly forever. The deeper truth is not that index funds suddenly stopped working. The real lesson is that every investment strategy must be understood within changing economic conditions. Blindly following any financial system without understanding risks eventually becomes dangerous. Smart investors in 2026 are asking harder questions about diversification, concentration, cash flow, inflation, and long-term market structure. They are not abandoning simplicity entirely, they are becoming more intentional. What do you think of our video? Let me know in the comment section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.